The shadow banking network is a part of the global financial system that operates outside traditional banking regulations. It includes institutions that perform banking-like activities without being official banks. These institutions do not take deposits like normal banks, but they still provide credit, create liquidity, and help move money across the economy. The term shadow banking was first used in the mid-2000s. It does not mean illegal banking. Instead, it refers to financial activities that happen outside the usual banking framework. Because these activities are not performed by regulated banks, they operate in the shadows of the financial system. Examples of shadow banking institutions include money market funds, hedge funds, broker-dealers, private credit lenders, and securitization vehicles. These organizations help companies borrow money, help investors earn returns, and support financial markets with liquidity. Many of these institutions grew rapidly after the year 2000 because new regulations made traditional banking slower and more expensive. For instance, after the global financial reforms of the early 2000s, regular banks needed to hold more capital. This made them safer but reduced the amount of loans they could offer. Businesses still needed funding, so they turned to non-bank lenders who could operate faster and with fewer restrictions. As a result, the shadow banking sector grew extremely quickly. Today, shadow banking institutions control nearly half of the world's financial assets. According to recent global reports, non-bank financial intermediaries now hold about 49% of global financial assets. This growth is one of the biggest changes in modern finance. A key feature of shadow banking is that it uses short-term borrowing to fund long-term assets. This can make the system efficient, but it also makes it fragile. If lenders suddenly demand their money back, some shadow banking institutions may not be able to repay quickly, which can cause liquidity problems. For example, a money market fund may lend billions overnight to a broker-dealer. The broker-dealer may use this money to buy securities. These securities may then be sold to another investor. This creates a chain of transactions that relies on trust and constant liquidity. However, the risk appears when confidence drops. Since many of these institutions are not protected by deposit insurance or central bank support, they can face severe problems if investors panic. This is what happened during the 2008 financial crisis, when several shadow banking institutions collapsed due to mortgage-backed securities losing value. The collapse caused a chain reaction across global markets. Funding dried up, confidence fell, and even traditional banks were affected. The crisis demonstrated how interconnected the shadow banking system is and how quickly problems can spread. Although the crisis exposed many weaknesses, shadow banking continued to grow afterward. Regulations on normal banks became even stricter, pushing more financial activity into the shadow system. This expansion created new opportunities but also new risks. But how is this entire invisible mechanism even operating? The shadow banking system functions through several key mechanisms. One of the most important mechanisms is short-term funding. This includes repurchase agreements, commonly called repo agreements. A repo is a type of short-term loan where one institution sells the security and agrees to buy it back later at a slightly higher price. Repos are essential because they allow institutions to borrow quickly using securities as collateral. Billions of dollars move through the repo market every night. This makes it a major source of liquidity for financial institutions that are not banks. Another important concept is rehypothecation. This occurs when the same piece of collateral is reused multiple times in different transactions. For example, a government bond used as collateral in one repo may be reused by another institution in a different repo agreement. This increases liquidity but also increases systemic risk. These chains of transactions work well when markets are stable, but during stress they can break quickly. If one institution refuses to lend or demands more collateral, the entire system may become unstable. Because shadow banking relies heavily on short-term borrowing, even small disruptions can cause large problems. This instability became clear in 2019 when the US repo market experienced a sudden liquidity shortage. Overnight interest rates unexpectedly jumped to nearly 10%, which signaled that institutions were unwilling to lend. The Federal Reserve had to intervene immediately to stabilize the market. Another major risk area is private credit. Private credit funds lend money to companies that may not qualify for traditional bank loans. This market has grown quickly and is now valued at more than $1.7 trillion. While private credit offers flexibility and opportunity, it is less transparent than traditional lending. Investment funds also contribute to risks. Some funds allow investors to withdraw money daily, even though they hold assets that cannot be sold quickly. This creates a liquidity mismatch. If many investors withdraw at the same time, the fund may be forced to sell assets rapidly, which can drive down prices and create market instability. This happened in March 2020 during the early phase of the pandemic. Investors rushed for cash, and financial markets experienced severe stress. Even the U.S. Treasury market, which is usually considered the safest financial market in the world, became unstable. Central banks stepped in to restore order. These events revealed how dependent financial markets are on shadow banking institutions. When markets operate normally, shadow banking provides efficiency and liquidity. But during crises, the same mechanisms that make it efficient can amplify instability. One thing is clear: shadow banking is powerful but fragile. It can support global finance during stable conditions, but it can also accelerate crises during unstable periods. We just saw the risks during market stress. But what if the real danger begins long before anything crashes? Up to this point, shadow banking might sound like a hidden financial sector that becomes dangerous only when markets panic. But the most overlooked issue isn't the crisis itself. It's what the world becomes after shadow banking has already taken over. In other words, what if the system doesn't collapse, but instead becomes unstoppable? Today, global finance depends on shadow structures more than ever. Corporations, governments, pension funds, and even central banks rely on non-bank liquidity to function. Each year, more credit moves outside the banking system, and each crisis pushes it further. Instead of reducing risk, the world has unknowingly outsourced risk into places no one can fully monitor. One of the biggest transformations is invisible. Shadow banking is slowly becoming the primary credit system for the global economy. When traditional banks step back, shadow institutions step forward, filling every gap. Over time, this doesn't just create an alternative system, it becomes the system. That means the very thing considered shadow may soon be the main source of global funding. Shadow banking evolves faster than regulation. When authorities tighten rules on banks, innovation simply moves somewhere else. New structures appear, new funding channels emerge, and new loopholes open. Every attempt to contain risk creates another version of it, a game of financial whack-a-mole where regulators always strike too late. A more dangerous possibility is fragmentation. Shadow banking is no longer dominated by one country. China depends heavily on non-bank financing to support real estate and regional governments. Europe relies on investment funds rather than commercial banks. The US depends on repo markets and private credit. If a shock begins in one region, other regions may respond differently or not at all. Suddenly, global liquidity could split, instead of working like one connected system. Some analysts believe the real threat is not a crash, but a world in which nobody controls liquidity anymore. If financial power drifts from banks and regulators toward decentralized shadow structures, who decides what stability even means? Who takes responsibility when something breaks? And what happens when critical parts of the system are operated by institutions that don't answer to anyone? Even more unsettling is that shadow banking is now merging with technology. Automated lending platforms, algorithmic refinancing, and real-time collateral trading can move billions without human decision-making. That means the next crisis could escalate automatically, before anyone even realizes a problem exists. In previous crises, panic took time to spread. Now markets can collapse faster than regulators can react. All of this raises a possibility that many experts consider far more dangerous than a traditional financial crisis. Not a sudden crash, but a gradual shift of financial power into structures that are invisible, unregulated, and potentially uncontrollable. A system nobody planned but everybody depends on. So the most important question is no longer whether shadow banking could trigger the next crisis, but whether the world has already crossed a point where the most important part of global finance no longer lives inside the banking system at all.